Hello, and welcome to Credit Compass, your guide to navigating European credit markets. Disruption through the Strait of Hormuz continues, and the endpoint appears to have been pushed out indefinitely. At first, the market conversation was relatively narrow. What does this mean for oil prices, and how much of that move feeds through into inflation? But the fallout has started to metastasize into something broader, a general feeling of uncertainty. For consumers, that uncertainty shows up at the petrol station, in the grocery aisle, and in the monthly budget. For businesses, it shows up in delayed investment decisions, questions about input costs, and less confidence in where demand is heading. This week, we take a closer look at how that uncertainty is beginning to affect Europe. Let's start with the consumer. Consumer confidence has declined. April readings across the major European economies have been released over the past several weeks, and the direction has been consistent, down from the prior month, and in nearly every case below expectations. In the UK, the GfK Consumer Confidence Survey has dropped considerably since the Iran conflict broke out. After moving gradually higher through 2025, it has fallen sharply to its lowest level since 2024. It remains well above the lows reached in 2022, but the scale of the change in direction matters. Sentiment was improving, now it has reversed. And the UK is not alone. Recent surveys for Switzerland, the Netherlands, Denmark, Belgium, Ireland, and Finland, recently released, all point to a declining trend. This is not simply a local story about one economy or one survey, it's a regional shift in confidence. That is not especially surprising. Consumers are facing higher fuel costs, elevated mortgage rates, persistent grocery inflation, and a steady stream of headlines about the on-again, off-again peace process. Add in concerns that AI may disrupt their employment, and it is understandable that households are becoming more cautious. The risk for Europe is that caution turns into demand destruction, as a decrease in affordability or interest can help contain inflation from the demand side. But it also threatens to keep growth subdued. For economies already struggling to build momentum, weaker confidence can push out the timing of any meaningful recovery. Germany is a useful example. The ZEW Expectations Survey, which asks German investors about their views of the next 6 months, produced its lowest net reading since 2022. At the same time, views of the current German economic situation remain historically weak. That combination is important because investors had expected fiscal support to help unlock a turnaround. So far, that support has not yet been enough to convince investors that the recovery is firmly underway. Now let's turn to the other side of the economy, businesses. Business confidence has also weakened. Business confidence indices and PMI surveys have generally pointed to more negative sentiment in March. The reaction has been less severe than the move in consumer confidence, but the direction is still softer across much of the continent. In Germany, the IFO survey suggests that businesses' expectations have deteriorated. In France, business confidence declined and came in below expectations. Recent PMIs add another layer of evidence that business sentiment has soured. That said, the picture is not uniformly negative. Swedish and Swiss manufacturing PMIs from March moved considerably higher. Even the French Manufacturing Confidence Survey for April, released last week, surprised to the upside and turned positive. So, while the broad story is one of weaker sentiment, it is not a story of uniform deterioration. There are still pockets of resilience. That distinction is important for credit markets. A broad-based collapse in confidence would point to rising default risk and a more acute tightening in financial conditions. What we have instead is a more complicated picture. Uncertainty is clearly weighing on decisions, but parts of the economy are still adjusting rather than breaking. While markets wait for a clearer conclusion in Iran, a portion of the initial shock appears to be wearing off. Businesses and consumers are not necessarily comfortable with the new environment, but they are beginning to adapt to it. Now, another set of surveys has also come out recently, and these are especially relevant for central banks meeting this week and next. In Europe, the ECB survey of consumer inflation expectations rose sharply, with one-year expectations increasing to 4% from 2.5%. In the UK, the Decision Maker Panel survey also pointed to a one-year inflation expectation of 4%. They are both well above expectations and notable given the slightly weaker employment backdrop. Inflation expectations can influence behavior. If consumers and businesses believe the current spike in input costs will persist, that can feed into wage negotiations and selling prices or secondary order effects. In that environment, central banks may find it harder to look through the shock as purely temporary. Producer price data adds to the concern. Recent producer price index releases suggest that higher costs are already moving through the system. PPIs rose sharply in Ireland and Italy. Italian PPIs have increased by more than 5% year over year, while Ireland recorded a 3% month over month increase in March. For central banks, this is the difficult balance. On one side, growth is softening and confidence is falling. On the other side, inflation expectations and producer prices are moving in the wrong direction. That combination complicates the policy message. Now, let's bring in another survey, the European Central Bank's Bank Lending Survey, which asks banks about credit standards, loan demand, and lending conditions. On the consumer side, demand for housing loans weakened compared to prior quarters, even though credit availability remained largely unchanged. Looking ahead, banks expect housing loan demand to decrease further. Demand for consumer credit also fell sharply, which is consistent with the broader decline in household confidence. On the commercial side, lending standards and availability tightened for businesses, largely because banks perceive greater risk as a result of the rising commodity prices, but demand for lending also decreased. That suggests uncertainty is affecting investment decisions. Businesses are not necessarily rushing to borrow under stress. Rather, many appear to be pausing investment, inventory, and expansion decisions until the outlook becomes clearer. That's an important distinction. A drop in credit demand driven by distress would be much more worrying. A drop driven by delayed investment is still negative for growth, but it points to a more cautious corporate sector rather than one under immediate pressure. One last piece of recent data comes from Spain. After reaching a new record for employment in the previous month, the unemployment rate surprised to the upside, rising to 10.8% from 9.9%. This deserves attention as Spain moves into its busy tourism season. If rising flight prices weigh on travel demand, the summer could become more challenging than expected. We do not think that this is a foreshadow of the quarter ahead, but it is one to watch as we try to determine the scale of the impact the Iran conflict and indecision are having on the various economies and market sectors. So, where does that leave markets? Well, markets will be watching central bank communication closely for signs of how policymakers are interpreting the mix of weaker sentiment and higher inflation pressure. Expectations are for central banks in Europe to remain on pause. The more important question is whether they signal anything about the potential direction of the next vote. For now, the market feels firmly in wait-and-see mode. Credit markets have shown tentative signs of issuance, and the pipeline continues to build. But uncertainty has kept the issuance market largely on pause. Issuers appear ready to move when windows are open, while investors are still assessing how much compensation they need for that volatility, inflation risk, and weaker growth. Spreads have been relatively constructive, but are differentiated according to the level of risk. Equity markets, by contrast, have been resilient. They appear to be looking through the Iran conflict as a temporary disruption rather than a structural challenge to the broader growth story around AI and corporate earnings. For companies that have reported so far, there has been limited negative commentary about the quarter ahead. The key question is whether that resilience can continue if uncertainty persists. If households and businesses regain visibility on costs, policy, and demand, survey results should begin to stabilize and eventually reverse course. But if energy prices stay elevated and inflation expectations remain sticky, the recovery could be delayed. For credit markets, that means selectivity remains important. The central issue is not simply whether growth slows or inflation rises, it is how those two forces interact. Weaker demand can relieve some inflation pressure, but higher input costs can still compress margins and weigh on confidence. That is the tension that investors will be watching. That's all for this week's edition of Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others to discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass guide your way.